Could we please put our phones on mute, everybody? Thank you. Or our phones and us on mute, so that I can just cover things. I guess what I'm trying to say is that I've sent quite a strong communication through to Sarah Edwards, MP, who's chair of the APPG, all-party parliamentary group for SME house builders, basically demanding, in a sense, in a nice professional way, that Matthew Pennycook meets with a group of SME house builders. I've had to be selective and pick people from up and down the country of different shapes and sizes, from SME builders such as Joe Jelly, building maybe 5 to 10 units a year in Surrey, to the likes of Rob Boughton from Thacum Homes, that's building 1,000 units a year, and the likes of John Anderson from Allison Group. There's a range, and Paul Henry from Kent, from Esquire Homes. But I've got a selection of what I believe are SME house builders of the highest calibre that hopefully will be representing you all in the right way. But what I'd like to say is we are pulling together a bit of a paper, Anna and myself, and you all know Anna now from Hero Communications, that absolutely makes me look good. She's done a great job, I think she has anyway, in making me look good on these forums that we're pulling together. So if there are any issues, any real pertinent things that you want us to raise on the 15th of October, then please share them with Anna and myself. We are capturing that. We are sending stuff through. We are not looking for a debate. We're looking for actions. So we've not only got these SME builders sharing the challenges, we've got them saying what the government can do with immediate effect before Christmas to make a meaningful difference to help the survival of SME builders, and not to be on their watch the demise of this vital sector of the housing market. So I can't invite everybody. We've got a limited number, but we've really gone out of our way to get a cross-section of people from all over the country of different sizes, so that it's representative whether you're building 5 units or whether you're building 500 units or whatever. So for me, it's what Anna and I are doing, and what I'm doing as my role as secretariat to support this vital sector that I believe in passionately. So that's one of the things I wanted to share with you. Second thing is, you will all know that I'm working with a gentleman called Ben Bolger, the executive director from the King's Foundation, and we set up the Regional Building Foundation and a steering group to champion the interests of SME house builders and help them gain access to land. That is moving at pace. We have a meeting on the 15th of October as well, after the meeting at the Houses of Parliament, where we are in the process of moving that and setting that up as a completely business entity in its own right. So it will have a license through the King's Foundation in terms of certain aspects, but it's going to be set up as a business which will be pulling together landowners, SME house builders, funders. It will be quite a significant thing which will be sharing. And I'm absolutely delighted to say that I've been asked to join the board of the Regional Building Foundation, which I have accepted. So I will be championing that, and that will give me the ability to hopefully continue to support you, not just in terms of my secretariat role, but obviously in terms of now working with legacy landowners up and down the country, and look at how we galvanise that to open up opportunities for SME house builders. So that's it from me. I'd like to just hand over to Anna very, very quickly, because we've got some exciting news. I said she's working bloody hard to make me look good. We are going to start professionalising the R&B Developers Forum, but what we don't want to do is to change it from what it's become. It is not my forum, it's not Anna's. I have purely been facilitating and coordinating these activities to support yourselves. And I'm going to hand it over to Anna, that will give you a little bit of an insight into what we're planning to do. Over to you, Anna.
Thank you, Edwin. Good morning, everyone. I don't want to get in the way of Gareth's presentation, but I did have a couple of updates and just wanted to get a bit of a gauge from the room as to the direction of travel with two important areas, which is the website, which we're going to be launching in September, and then the brand, which we're going to be looking at in to coincide with the website launch. Now, I know when the forum was first initiated, it was called the Band of Builders, and I think everyone had quite an affinity with that name, and we actually had to change it because of the charity that was in existence at the time. We've obviously met the charity owners at the last Shooting and Innovation event, and we kind of rebranded as the R&B Developers Forum. Now, we're at a stage now where we're looking to professionalize the organization to a degree. We don't want to lose the magic and the chemistry and the kind of brilliance that it has, but it's a great opportunity for us to look at the name. And so a couple of people have suggested different options, and I wanted to get just a show of hands to see what everyone preferred. So there's three options that we're looking at. The first one is changing it to the regional and bespoke, so keeping R&B but House Builders Forum, so that it's a bit more, you know, Ron Sill does what it says on the tin. It's about house building, and people will understand it a bit more easily. Make it a little bit more professional to go to the Regional House Builders Forum, so that's option 2, or go back to the Band of Builders, which is option 3. So if I could get a show of hands for the preferred option, whether it's 1, 2, or 3. So if it's keeping it regional and bespoke but changing it to House Builders Forum, could you raise your hands, please? All right. That's great. Thank you. Oh, 20. Okay. And then if we want to professionalize it and keep it to the Regional House Builders Forum.
No idea.
Fix there.
Right, thank you. It was funny though, wasn't it?
Excuse me, whoever's on the phone, could you please put yourself on mute? Thank you.
Okay, great. And then option 3, going back to the Band of Builders. Ah, okay. All right.
There's not a lot in it.
I mean, there's not a lot in it, but I think number 1 wins. So, and that's actually what we were looking at, Edwin. So that's okay. Quite good. So yeah, so watch this space. If anybody, I've had some really amazing feedback from people in terms of what they'd like to see going forward in the events and the structure, and you know, really great ideas. So if you've got any more, please do come forward, because this is the time we're going to be shaping everything, and yeah, we want to hear from you.
Just on that note, just to say that we're going to be setting up a website. We're going to be doing various things. And as you know, I'm not getting any younger. Anna keeps telling me that. I'm trying to look as young as I can, but I can't defy age. And I'm going to be delighted to say that a young man, he happens to be my son, Aaron De Silva, is going to be joining as a director, as I said, professionalise it really to maintain and ensure that we can enjoy this 25 years from now. This continues to grow and be a voice of the industry for this market sector. So Anna, myself and Aaron, as it stands at the moment, will be directors of what we're looking to do. We are not looking to make it anything like the HBF, because they do a fantastic job, anything like the Federation of Master Builders. This is a unique forum. It's a broad church, and it actually embraces people of all shapes, colours and sizes. And when I say that, I mean size of house builders. And therefore we want to maintain those ethos and values that's actually grown it without even trying, but organically from 16 to 300 SME builders that are now part of this. So we're not going to change that because it's your forum. We just happen to be pulling it together. But because of the numbers and because of the calibre of guest speakers that we're now able to entice that want to come onto this forum. I think it's time that I realise that my ability to take it to the next level is probably needing the likes of a younger De Silva, and also a very, very professional lady that really understands how we should communicate and do things. Having worked, she's now working directly with the King's Foundation, Close Brothers Bank, the Hill Group, and etc. So Anna is a great addition that I certainly won't be able to do without as we go forward and move forward. But there's some exciting stuff happening which we'll be doing. But that's enough. Gareth, again, a massive welcome. We love you on this forum, and I know you've agreed to do it on a frequent basis, maybe every 3 to 4 months with us. So thank you very much indeed, Gareth, and I'll now hand over to your good self.
Brilliant. Thanks, Edwin. Thanks for that. Hopefully everyone can hear me okay. I'm just going to share my screen, which hopefully you'll be able to see. So give me 2 seconds. Great. Can everyone see that? Just someone give me a shout. Yeah, brilliant. Okay. Yep. So I'm going to spend the next 20-25 minutes just talking through where we see the economy, really. I mean, last week we published our monetary policy report. I'm sure that you all saw kind of the headline, which was that we cut rates to 4%. Within that, I think there's another story, and I'll try and bring it out in the slides. The vote was a lot closer than markets were expecting. So the vote ultimately was 5-4. I'll come back to that because we had a second vote for the first time in the MPC's history in 27 years, which really is as exciting as it gets when it comes to central banking. So I'll try and talk you through why that happened and why there's a divergence of views on the MPC. Before I start, there are some familiar faces on the call. For those that don't know me, I'm one of the bank's agents. I'm based up in the Northeast, and as well as the day job, which is speaking to a wide variety of businesses across sectors, sizes, shapes, etc. We're also in the Northeast. Myself and my colleague Maurizio are the central point of contact for the MPC when it comes to agency intelligence on the housing market. So any intelligence across the UK is funneled through us, and we're the point guys for the MPC to come and speak to when it comes to the housing market. So these sessions are really useful to us. I guess, A, for us to be able to deliver the message to you, but B, for the questions that hopefully you'll have kind of lined up for me at the end. I can't see the chat while I'm doing this, so save them to the end, pop your hand up, and I'll do my best to answer them. So, and I'm saying this, it now won't move. My screen's stuck. Hopefully that has moved.
Yes, it has. Yeah.
Great, excellent. So we'll start with the growth outlook. We're waiting for the latest GDP figures, which come out tomorrow, which will give us Q2 GDP. Let me put a bit of context to this and a little bit of the story behind the headlines, if you like. So the graph here shows what we class as underlying GDP in the orange diamonds, which is based on survey indicators. So it's things like PMIs, it's things like some of the data releases that you get around the housing market, around business confidence. The blue line is the headline GDP figure. So Q1 GDP was surprisingly strong. In our view, we had Q1 GDP growth of 0.7%. The underlying picture we see is weaker than that. So for Q2, we'll find out tomorrow what that's going to look like. We think that headline GDP will grow by 0.1% in Q2. We think it will grow by 0.3% in Q3. The orange diamonds that you can see, underlying GDP growth we thought was virtually flat based on the service indicators in Q1. It picks up a tiny bit in Q2 and a tiny bit in Q3. I guess the takeaway from this graph, and the Deputy Governor, one of our Deputy Governors, Claire Lombardelli, I'm paraphrasing slightly, but not that much. In the press conference after we released the monetary policy report, said that UK GDP growth was nothing to celebrate at the moment. And what Claire's talking about there is below trend level growth in the UK economy. And I'll come on to a fan chart in a minute that shows where we expect GDP to grow over the next 3 years. And throughout that 3-year period, it's below what we would class as trend GDP growth, which is around about 2%, a little bit lower than 2%. So watch this space on the figures tomorrow. In order for Q2 to be in growth territory, we've got to have a positive picture for June GDP. We think we will, but it only just keeps it in positive territory. This graph I'm going to include because we get a lot of questions, obviously, on trade at the moment, given what's happened in the US in terms of tariffs. One of the reasons for the strength in GDP, in headline GDP growth in Q1, we think was a story of stockpiling in the US of imports from the UK. So getting ahead of the tariffs before they came in. Since that, and you can see on this graph here, the April-May figures were much more in much more negative territory. So exports from the UK to the US fell by about, well, just under a third, 28% in that April-May period. We think underlying that as well, there's been a bit of a slowdown in export growth over the last year. So automotive exports to the US, for example, have fallen by about a quarter over the last year. And we think that if we kind of took this graph out to the right, then export growth in the coming months is likely to be weaker. And I guess it's also worth pointing out at this point that although the UK and the US, struck a trade deal in the immediate aftermath of the announcement of tariffs, we are still in a position where tariffs between the UK and the US, the other way around, UK exports going into the US are much higher than they were prior to Trump taking up the presidency. So that's the context, and as a result, we do expect that to weigh on export growth looking forward. This is, and you'll have to trust me on this, a really interesting graph for us, because a lot of the growth expectations that we have are built on consumption growth picking up. So what this graph shows here is the household savings ratio, the proportion of income that households choose to save. And as you can see if you look from kind of early 22 to now, basically, the savings ratio has increased. Now, in that time period, what's also happened is that real incomes have grown fairly significantly, actually, by historical standards. And when I'm talking about real income growth, what I mean is the difference between wage growth and inflation. So inflation fell back from its peak, wages started to pick up, and as a result, real incomes grew. Now, ordinarily, we would have expected consumption growth to pick up by much more than it has. What has happened in effect is that households have chosen to save more of that real income growth than they have to consume. What happened in Q1 was that started to fall back a little bit. You can just see right to the right of that graph that the savings ratio started to fall. And the reasons for that are, well, ultimately, we obviously started cutting interest rates, so savings became less attractive. Inflation started to pick up a bit, and I'll come on to that in the future slides. And wages started to fall back a little bit. So what happened then is we think that households started to use some of those accumulated savings to cushion consumption. And a lot of our growth forecast looking forward is based on that savings ratio continuing to fall. So as I said, we've cut rates. I'll talk about where they're expected to go. We do expect wage growth to start to come off, and we've started to see that on the latest figures which came out yesterday. And inflation will pick up during the year. And as a result, we do expect that savings ratio to fall and consumption to pick up in line with that. This is one of our famous fan charts. It kind of goes off the screen to the left during the COVID period. But for those of you that haven't seen a Bank of England fan chart, what this shows is our expected trajectory of GDP growth over the next 3 years, which is our forecast period. The darker swathe in the middle is where we expect GDP to move. So this year we're expecting 1.25% growth, the same next year, picking up to 1.5% in the third year of the forecast. And a lot of that, as I said in the previous slide, is predicated on consumption growth picking up from where it has been at the minute, cushioned by the fall in the savings ratio. Real incomes, we do expect to continue to grow, although not at the same rate that they have over the past couple of years. And within that as well, further out in the forecast period, when we're talking about 1.5% growth in 3 years' time, and obviously I'll be interested to hear your views on this, a lot of that as well is built into housing investment picking up towards the back end of our forecast period. So, I'll take the kind of sharp intake of breath because I can't hear you or see you at the moment as I present these. No one that we speak to expects the government to reach, well, the UK to reach the 300,000 homes a year over this Parliament. However, we do expect new builds to start to pick up towards the back end of that forecast period, and some of that enables the GDP growth that we're talking about. You might be throwing daggers at me and I can't see you at this point, but we'll come to that at the end. This graph it's a busy looking graph, but we always show it. And it's also worth kind of pointing out at this point that this isn't the Bank of England's view as to where interest rates are going to go. It's the financial markets view. So the UK in blue, the dotted lines were the May report when I spoke to you last. The solid lines of the report that we released last week. What it shows is barely any divergence over the last 3 months. Markets still expect us to end up at about 3.5% in 3 years' time. This graph was produced before we made the rate cut last week. That was 100% priced in by markets. What has changed since the vote last week is market expectation of another rate cut in November. So prior to the vote last week, markets had almost kind of fully priced in that we would also cut again in November. Now the balance is still an expectation that we will, but it's closer to 60-40 now than kind of 90-10 before the vote last week. And I touched on that vote at the beginning. So the vote this time round, there are 9 members of the MPC, and the vote this time round was that 5 members wanted to cut by 0.25, which we did, and 4 members wanted to keep rates on hold. That went to a second vote, and again, that's the first time in 27 years that that's happened. In order for a policy decision to be made, we've got to reach a majority amongst that 9. And actually, the first vote was a 4-4-1. So 4 members of the policy committee wanted to keep rates on hold. 4 members wanted to cut by 0.25, and one of the members, Alan Taylor, wanted to cut by 0.5%. His view was that demand is weakening by more than the central expectation, and that the GDP growth graph that I've showed you in the previous slide, he expected growth to be below that, and as a result, that to pull on inflation. So we went to a second vote. Alan voted for the 0.25% cut, but the markets viewed that as quite a hawkish signal that actually, yes, we're still on a cutting cycle. However, previously we've cut on a quarterly basis, which has coincided with when we've released the monetary policy report with all the shiny new graphs that I'm showing you at the minute. Market expectations tempered a little bit in the sense that the next cut might not come in a quarter's time. But again, they haven't changed their view on where we're heading over the forecast period. A couple of graphs here on rates and on the effect of rates on the economy. So this graph here shows the effect that our previous rate increases, are having on demand. So when we come to make a decision on rates, effectively we're trying to look in the future because there's a lag between us making a rate decision and it taking full effect on the economy. So what you see in here towards the right of the graph is the previous rate increases that we had are still what we call restrictive. They're still bearing down on demand. We think that restrictiveness has reached its peak, and if we moved further to the right, the cutting cycle that we're now on will start to reverse that and start to add to growth in the future. However, and the governor was at kind of pains to stress this in the press conference, because one of the first questions that we were asked, and I expect to have a similar question from someone in the audience today, is inflation's picking up. Why do you think now is the right time to cut rates? And actually, because we're looking through what we see as a temporary increase in inflation at the moment and into the future, we expect the restrictiveness to start to turn around, and we feel that in 18 months' time, once that kind of lag pass-through has happened, inflation will be starting to come down, and as a result, the decision that we make today will have the effect in 18 months' time. But that shows you the effect of, interest rates bearing down on demand, which effectively, is the job that we have in order to bring inflation back to the 2% target. And then the other graph that I had on rates, which obviously is going to be of interest to people on the call today, it's worth pointing out that despite the fact that we've cut 5 times now over the past year and a bit, from 5.25 to 4, that obviously has an effect on variable mortgage rates, almost kind of instantaneous effect on those. So they've started to come down in total. However, we do still have, a relatively large swathe of people on 5-year fixes that are still to come off at a 5-year fix at a low rate 5 years ago, still to come off at a much higher rate. And you can see that the fixed mortgage rates, this is the total stock of mortgages in the UK, that fixed mortgage rate will continue to tick up over the course of this year as the 950,000 or so people who have fixed mortgages at 1.5–2% come off and fix again at closer to 4. And as a result, the orange line in the middle, because obviously the vast majority of mortgage holders now have mortgage on a fixed rate, 80% plus on a fixed rate, less than 20% on a variable tracker rate. As a result of that, the overall mortgage rate, average mortgage rate in the economy continues to tick up very slightly towards the end of this year, which again talks about the restrictiveness and talks about the effect of interest rates on demand in the economy as a whole. So hopefully that makes sense. Happy to take any questions on this at the end. Moving on to the labour market, which I guess is the biggie when it comes to our assessment as to where the economy is heading and why we think inflation is going to come back down to target. So hopefully it'll all start to tie together as I go through this. First graph that I have here is around a slowdown in underlying employment growth in line with GDP being fairly weak over the past couple of years. So important to say at this point, and I would caveat a lot of the official ONS statistics at the moment with well, I don't want to say an unreliability, but the ONS figures over the past couple of years have been volatile, I think is probably the diplomatic way of looking at it. And as a result, we hang more weight now on some of the faster moving indicators, some of the HMRC data, some of the intel that we pick up as agents. But overall, what this graph shows, the central swathe shows kind of employment growth, if you like. Over the last, the results, the figures that we had yesterday showed vacancies fell for a 32nd consecutive month. There's been a downward trajectory of vacancies, so demand for labour has fallen. And despite yesterday's figures showing quite a significant increase in employment growth, a lot of that is based on kind of corrections from previous ONS releases. We think that employment growth is just below 0 at the moment, so it's just slightly in negative territory. Unemployment, we do expect to pick up a little bit, but ultimately what this is telling us is GDP has weakened, employment growth has weakened. Again, labour market's still fairly tight, but the growth in employment has weakened with it. This is our unemployment fan chart. So unemployment on the latest reading is 4.7%. We expect it to pick up on the central swathe to around about 5% over the forecast period. And actually quite a bit of that pickup could be in the coming months. So by the end of this year, I wouldn't be overly surprised if unemployment was closer to 5%. And then we think that it stays around about that level over the forecast period, which talks about some slack opening up in the economy. And again, when it comes to our thinking around inflation, our rates, previous rate increases at what we see as restrictive, but we do see that kind of slowing in GDP growth, that slight pickup in unemployment as another factor that starts to weigh on inflation through wage growth as we go forward. And on that wage growth, latest figures yesterday showed that private sector wage increases were averaging at 4.8% on the latest reading. It has started to come down slowly, more slowly than we're expecting, and higher than is kind of is desirable for a 2% inflation target. By the end of this year, we expect that 4.8% to be closer to 4, based on our own pay survey that we hold as agents, decision maker panel, some of the faster moving HMRC stuff. And certainly when I'm speaking to contacts in the region, and looking at what my colleagues are picking up around the country, we are starting to see that forward-looking wage increases. So firms that are talking about wage increases in October, for example, they tend to be closer to the 3.5, 4 than they have been in previous months. Now, obviously, that slowdown in the labour market, labour demand coming down, wage increases starting to come off. We think again that gives us some confidence that although inflation is going to pick up, and I'll talk about why in a second, that it does start to come back down towards target in our forecast period. This one's quite an interesting one. So for all that I'm talking about kind of headline wage increases coming down, and they are, both on the official data and both on what we pick up, there's a wedge that is opened up between expected pay and expected total labour costs for firms. So obviously a lot of employers on the call at the moment, this will resonate with you. That wedge is effectively the national insurance contribution increase. So what that's meant is that one of the kind of the routes to mitigate that firms have had is they could choose to try and pass through the national insurance contribution in price, which some have been able to do, others haven't. But one of the other routes has been lower wages going forward. So for example, a firm saying that we gave 4% last year, we probably would have given 4% this year, but actually we've got these extra labour costs because of national insurance contributions. So in order to mitigate that increase, we're only going to give a 3% pay increase this year, which is another reason that wage increases have started to come down. And again, that wedge will come back down, because unless the government increased national insurance contributions again, which obviously there's no indication of, then that filters out of the readings, and we expect those to converge again. So finally, sharp intake of breath and a quick swig of coffee before we move on to inflation. This graph here, I think I've shown to you before. This shows composition of inflation. So the latest reading that we had was the June inflation figure, which was 3.6%. We get the next reading next week. We expect it to be there or thereabouts, potentially slightly higher than that. And the reason that inflation's picked up, so we got to a point in September of last year when CPI inflation was back down to, well, it was below target, actually. It was 1.9% in September last year. One of the reasons, the main reason that it's picked up since then is the orange bars that you can see here, which is the contribution of energy to the inflation figures. They were a drag on inflation for a significant period of time, because obviously inflation compares one year against the previous in terms of price. You had the huge energy shock that added an awful lot when inflation peaked. Energy prices came down, and as a result that dragged on inflation. That drag has reversed now. So the latest Ofgem price cap that we had in July was 10% higher than previous years. So actually energy is now adding to inflation. The other bar that I'm going to spend a little bit of time talking about, because it's significant, although food only makes up 11% of the entire CPI basket, food inflation started to pick up, and it'll pick up a little bit more over the course of this year. So those purple bars that you can see there will add more to inflation going forward. And then the final one is services inflation. As you can see, currently, so the white line is where we are overall for CPI inflation. The bulk of that is made up of services inflation, which is the biggest part of the basket. 50% of the CPI basket is services. And for services businesses, they have a higher proportion of their costs are made up by labour. The people-intensive businesses, so wage increases for services businesses mean that there's been more of a pass-through into price than some other sectors, and that's remained fairly dogged. It started to come down a little bit, not as quickly as we would have liked, but we are starting to see that come off a little bit. This graph, again, this is something that we pay an awful lot of attention to, and hopefully in the last couple of slides that I'm going to show you, I'll try and explain why. So these are expectations of inflation, where households and businesses expect inflation to be in the short term, which is 1 year, and the medium term, which is 3 years. The dotted lines there are kind of historical averages of household expectations. And you can see from the graph on the left that both are above historical averages. Inflation's above the 2% target, and households in the short term expected to be around about 4% in a year's time. And in the medium term, over 3 years, they also expect it to be 4%. We don't. We expect it to be lower. Why that's important from a household point of view is that that tends to drive wage bargaining. So in other words, if households expect inflation to be 4% in a year's time, they will set their wage demands at 4% to cover inflation. So the higher that is, the more what we call entrenched the inflation position becomes. Now that is important because a lot of the drop off that we forecast in inflation comes from wages coming down. If that expectation gets more entrenched, then that becomes more difficult. As you can see on the left, on the right, business expectations tend to be below household expectations anyway, but both are around about 3% medium term, 3% longer term, which again, our target's 2%. If expectations become embedded at those levels, it becomes more difficult for us to shift things. Wordy slide here. It's the food inflation point. I think it's really worth just spending the last couple of slides explaining why food inflation is so important. So on the latest reading, food inflation rose to 4.5%. We expect that to tick up further over the course of this year to about 5.5% by the year end. Food inflation, not inflation in general. Which is lower. I mean, at one point, food inflation was running at kind of 20% on the back of the energy crisis in late 22, early 23. It's a lot lower than that. However, the last bullet is the important one. Food prices can have what we call an outsized effect on households' inflation perceptions. In other words, food prices are really salient when it comes to households having an expectation of inflation. You go to the supermarket, the packet of pasta that you bought last week is 10% more expensive. Your inflation perception is inflation is going to be 10%. So although it's only 11% of the entire CPI basket, food, it has a real significant effect for households in setting expectations. And the reason for that is kind of, I guess, highlighted in the graph here. So what this shows here is percentage increases. So the axis on the left of significant household food items. So beef's increased by over 20% in the past year, butter by 20%, chocolate by nearly 20%. I'll give you an insight into my diet here. That has even a more oversized effect for me because I eat a lot of all three. The brackets at the bottom are how much of the food basket is made up of those products. So 2.2% of the food basket is beef, and so on and so forth. But those significant increases in staple items have an oversized effect on household expectations of inflation. So everyone's had the conversation of crikey, that mince that I bought 2 weeks ago, or well, not 2 weeks ago, 2 months ago, is like 50% more, 50 pence more expensive. Inflation is really kind of picking up more than the headline figure would suggest. So again, we hang a lot of weight on this because it drives household expectations. And the other point to make is that food inflation in the UK has picked up more than it has in the euro area. So you look at some of the things on the graph that I've shown you there, a lot of these are global commodities. So chocolate, for example, coffee, they're global commodities on a global commodity market. So the question then would be, well, okay, we understand that food inflation's picked up, but surely it should have picked up by the same amount in the UK as it has in the euro area and in other parts of the world. And the reason that the UK is a bit of an outlier here is in the last chart that I'm going to show you now. Two specific UK drivers: higher labour costs, larger as a result of national insurance contributions going up, national living wage going up by a significant amount, and wage increases going up as in the economy in general by a larger amount. And also government regulation legislation. So there's a new packaging waste tax, which is due to come in October. We think that a lot of packaging companies have got ahead of that and have already added their price increases in. However, there's more to come. So as it says at the bottom, we expect food inflation to pick up to about 5.5% by the end of this year, from 4.5% at the moment. And as a result, I haven't got the inflation fan chart to show you, but we expect inflation to peak, CPI inflation as a whole, at about 4% in September of this year, before it comes back down to target. We think we'll be back to 2% target in about 2 years' time. So I'm going to stop sharing. I always have this horrible moment now where I think I've just been talking to myself for 25 minutes and no one's going to be here. So I'm glad you're here. That's a good start. And I'm happy to take any questions. And I don't know if you want to field the people.
Gareth,